Alrighty, welcome everybody. My name is Sean King, and I am a retirement income specialist, and I'm here to talk to you today about infinite banking. Now, I know there's a lot of information out there, some of which you might have already seen on social media or other places on the internet. There's definitely some great information out there, but let's be honest, there's also some not so great info, which is exactly the reason why I made this video. It's really to cut through all the noise and get down to what infinite banking really is and what it can do for you. That way you can make an informed and educated decision on whether it's the right vehicle for yourself and potentially your family as well. Now, I'm a firm believer that if you can't explain something clearly in a way that everyone can understand, then you probably don't fully understand it enough yourself. So, with all the complexities that there are to infinite banking, the best way that I found to describe it to you is to actually tell you what it does. So, here's a testimonial from one of my clients. His name is Jonathan. So, Jonathan said, I had nearly 13 years of scheduled debt payments piled up in front of me: chiropractic, school loans, a mortgage, cars, and credit cards. With my infinite bank, I'll be completely debt free in 4.5 years without adding a penny to my monthly bills. In 20 years, I'll have over $900,000 in assets. In 30 years, it'll be over 1.7 million. Crazy thing is, that money is additional retirement income and it's all tax-free. While the money is great, knowing that I'll be able to cut back on my hours and have more time to spend with my family is really what matters most. Listen, I wish I knew about this stuff when I was in high school, or I wish they taught it to you when you were in college. I wish somebody had educated my parents about it. But the truth is, they didn't. I didn't learn it back then, and they didn't learn it from anybody when they were growing up. What I can tell you is the next best time to learn is right now. So that's exactly what we're going to do. So, what all of this really comes down to is one basic question. And that question is, if every dollar you made was suddenly worth two, if all your debts were paid off, would your life become more comfortable? I have to imagine that it would be. Let's be honest. Everybody would like to be debt free. So let's get down to the fundamentals of infinite banking. First off, who uses infinite banking? Well, the infinite banking concept started off over 100 years ago with the Rockefellers. Fast forward a couple of years, and you have Walt Disney, who took out a loan from his infinite bank to start up Disney World and Disneyland. You've also got guys like Ray Kroc, who started McDonald's with a loan from his infinite bank. Might have been able to do without that one. But you've got people like Magic Johnson. Shout out to the Lakers. If you're not a Lakers fan, this isn't going to work for you. Totally joking. The majority of US Congress, Warren Buffett. You don't have to be a billionaire, though, to use infinite banking. You've got people like Jonathan that we just spoke about. Many of my other clients, myself, my friends, my family, people who I told to stop doing what they were doing and just take 45 minutes and listen, because this infinite banking stuff can and has really changed people's lives. So, infinite banking and when to use it. It's ideal for families, when they don't want to have debts during their retirement years, which nobody does. It's great for people who want to become their own private bank, and we'll kind of dig more into that as we go. People who want to pay off their mortgage, their car loans, their credit cards, their student loans, which are never forgiven, personal loans, anything with interest rates added to it without adding any additional payments on a monthly basis. So I told you guys that I wasn't going to use a ton of financial jargon. So if you take the concept of infinite banking down to the very core, the easiest way I explain it is really to just call it a savings account on steroids. Now, this savings account on steroids does several things. It allows you to earn higher interest payments, guaranteed growth, allows you to use every dollar twice, access to your cash without penalty. That's a big one. Liquidity and access is what it's all about. It also helps you generate additional income. Consider this a side hustle. It's really a business that's continuously working for you in the background, day in and day out. Gives you greater control of your money, because who doesn't want to be in control? Provides tax-free income. That's probably one of my favorite things. It shelters your assets but certainly not least, the generational wealth. It gives you the ability to create generational wealth for your family. I'm going to unpack that in the next few slides here. Infinite banking. What is it? Infinite banking is based on participating whole life insurance. Now, before you go shutting off the video because you think you know all about whole life insurance, this is not your parents' or your grandparents' whole life insurance. It uses laws and US tax code to create a protected and guaranteed financial bank wrapped inside of a life insurance policy. You get the benefits on both sides. While it does have a death benefit, like traditional insurance, it's structured to minimize the death benefit and maximize cash accumulation inside the program. So, right out of the gate, I feel like this is kind of a mic drop moment here. In June of 2023, the FDIC came out with a report stated that the average interest that banks are offering for us to keep our money in their banks or their accounts is 0.42% versus the 5.8% that you can earn in an infinite bank with the carrier that I'm thinking about off the top of my head. This company has paid out at a performance rate of 5.8% over the last 3 years. That's 2020, 2021, and 2022. I'll mention 2023 in just a second, but some of you might be thinking, all right, the past 3 years, 5.8%. That's great, Sean. But have you buried something in year 4? Or what about, 2023? What happened then? Well, take a look. So here's the past 20 years. Now, like I mentioned, 2023 is not on there. They recently came out with those numbers earlier this year in 2024, and that final percentage was 5.9. But as you can see here, over the past about 20 years, the lowest percentage paid out in the last 20 years is 5.6%, and that's going to be in 2009 and 2010. The highest that it paid out was 6.83%, and that's in 2016. Now, the past 20 years has included the 2008 housing market crisis and the 2020 COVID crisis. During both those points, people were literally losing their retirement income. They were losing their life savings. People who were using infinite banking from this carrier at the time, though, in 2008, were getting that 6.32% guaranteed. In 2020, they were getting that 5.8% guaranteed. So as you can see, there's a lot of value in having a safe place for your money to grow. Now, it doesn't stop there. Infinite banking provides you with continuous compounding interest. For those of you who don't understand the difference between continuous compounding interest and simple interest, let me try to explain. So simple interest is your principal plus the interest that you earn. Continuous compounding interest is the principal plus the interest plus the interest on top of that interest on top of the principal. Sounds pretty complex, but believe me, you want compounding interest. So good old Mr. Albert Einstein says, he who understands it earns it, and he who doesn't pays it when it comes to compounding interest. I think that might be even truer than Mr. Einstein knew. So let's discuss the power of uninterrupted compounding interest. Now, you've probably seen this question out there somewhere on the internet at some point. And the question is, would you rather have $1 million today or a penny doubled every day for 30 days? Now, if you don't understand the power of compounding interest, you might say the $1 million. But if you do understand it, you know the obvious answer is the penny. Let's take a look at how this plays out. Day 1, you have, of course, doubled your penny. Day 20, you have just under $10,500. But by day 30, you have over $10,700,000. That's the power of compounding interest. Now, I want this to be clear. I am not suggesting infinite banking will take your pennies and turn them into millions of dollars. This is 200% compounding interest daily, while we're talking about 5.8% annually. But I also want to be clear about this. Your infinite bank over time does have the ability to become more and more efficient. efficient enough where it can start doubling, tripling, and even quadrupling the money you put into it on a yearly basis. I can also tell you that 5.8% compounding interest is going to beat 0.42% simple interest all day and most likely twice on Sunday as well. So, just like I mentioned, infinite banking provides you with more value over time. We're kind of getting that idea. It's the only financial vehicle where your contributions go down over time and your cash value and death benefit go up. Now, the reason that you're looking at an arch line up right here is because this is actually showing you the incredible power of compounding interest. The longer it goes, the more efficient it becomes. This is usually where people's brains start to break, so bear with me and I'll try to make this as easy as possible to understand because we're going to be showing you how you're using every dollar twice. Now, if you had $10,000 in your local bank, let's say you bank at Bank of America, Wells Fargo, Chase, you name it. If you had 10K in the bank and you took 90% out or $9,000, how much money do you have left over? Simple math says $1,000. Now, if you took that same $10,000 and put it into your infinite bank and you took up to 90% out or $9,000, how much money do you have in your bank then? It's $10,000. You might be thinking to yourself, Sean, that math doesn't math. Let me explain. What you're doing is utilizing what we call a non-direct loan recognition. You're using other people's money. Essentially, you're using the carrier's money. But let's take it a step further. So infinite banking is one of two vehicles where you can have one pile of money, call it cash, that you can take money out of, meaning use it outside the policy. So we've got outside the policy cash. You can pay off debt, finance purchases, while it's still earning inside the policy and saving for your future. You're using those dollars twice. We say that it's better than a loan because it's already your money, and it's better than a savings account because you earn interest on the entire principal, even if you are using the money outside the policy. Okay, access cash without penalty. Let's discuss this. Here's a traditional banking model that most people should be pretty familiar with. You've got income coming in, and that's going into your checking account. Most banks say, hey, if you open up a really cool savings account, you can transfer money into your savings account, and we'll give you a few extra points of interest on your money. Your money will work harder for you, and you say, great, of course. So you transfer some of that money or into your savings account from your checking account. And then when your checking account starts to get a little bit low, you transfer money back from your savings into your checking, and then you can go spend it. Now, there's two main problems with this. First off, between those two green lines in your checking account, I think it's safe to say that we all know that the bank is taking our money and lending it to other people. It's what banks do. They're marking it up with interest and they're selling our money to other people to make money. Now, come on, I get it. They're a business. They're in it to make money, but they're making money off of our money, and we're not making any money off of our money. The issue here is this model. It's $1 earned and $1 spent. You earn the dollar, it goes in your account, it goes out of your account, you spend the dollar, and it's gone. There's no non-direct loan recognition in traditional banking. So let's go ahead and swap out your traditional savings account with an infinite bank, and let's talk through how this would play out. Let's say you get $1,500 income into your checking account, and you realize with this infinite bank, you have the ability to maximize the opportunity to make money on your money and minimize the ability for the bank to make money on your money. So you take $500 and you leave it in that checking account and you transfer $1,000 into your infinite bank. And then you immediately take 900 or 90% of that 1,000 back out and put it into your checking account. So really all you did was just give it a little taste. You're essentially just filtering that money through your infinite bank and pulling it right back out. So now you have $900 out in the world, but you still have $1,000 sitting there in your infinite bank, earning you that 5.8% compounding interest. That's $1 working in two places at the same time. And then the next month comes and you get another $1,500 into your checking account. So you keep 500 in your checking and you move that 1,000 into your savings. Again, same process happens. You take that 90% back out and you go out and you spend that in the world. So now you have $1,800 out in the world, while that original $2,000 still sits in your infinite bank earning interest, saving for your future. What happens when you do things this way? 100% of the funds that are deposited are recognized immediately. Your credit limit is 90% of your cash value. We already mentioned that. $1,000, you have access to 900. Electronic transfer funds usually happen within a few days. So with my policy, I've got money sitting in there and I say, hey, I need to get some cash out of this. I do it real quick online or on my phone, whatever. It's extremely quick, but it takes about 2 to 3 business days to get me my cash. So I end up seeing that money in my account in 2 to 3 business days. So it's not instant like it would be moving money from your Chase savings account to your Chase checking account, but it happens pretty quick. It also minimizes your typical bank's profit on your money and it maximizes your infinite bank's process. Now, the goal here, of course, is always to keep a responsible amount of money in your checking account, while at the same time maximizing the amount of money that you're filtering through your infinite bank. In doing that, so $1 earned, which is $1 that goes into savings, as well as $1 outside the policy. Simple math says that it's $2 for every $1. I want you to take a look at these two interest rates on the screen right now. We've got 11.05% from the typical bank and 5% from your infinite bank. If you've stayed with me up until this point, there's probably a question that's burning in the back of your mind, and don't worry, I'm about to address it. I went out to bankrate.com. I found that the average personal loan rate is 11.05%. Now, if you're borrowing money from your infinite bank, you have to pay yourself back at 5% on the year. Now, you might be thinking, hey, wait a second. If I'm not using my money, if I'm using the carrier's money, do I have to pay that back? The answer is yes, and that's a good thing. And I'm going to explain why. Remember, just a couple minutes ago, I shared that the past 3 years' performance from 2020 to 2022 has been 5.8%. So if your cost of loaning money is 5%, but you're earning 5.8%, how much are you actually paying on that loan? Again, easy math says negative 0.08%, which means that you're getting positive arbitrage. You are earning income even after you've lent yourself money. This is that side hustle for doing nothing more than what we all have to do on a day-to-day basis, which is finance the things of our daily lives. You have just become a bank and you are earning the income of a banker, which is interest. Now, let's take this another step further with an example. And let's say that you want to borrow $20,000 from your, local bank down the street. We'll call it Bank of America. So we borrow that $20,000, of course, if they allow us to, and we negotiate that we're going to pay it back over the next 7 years, which would be 84 months total. So I'm going to go to nerdwallet.com. You guys can definitely do the same thing to check out their personal loan calculator. Now, if you haven't been on NerdWallet, it's a great site with a lot of financial calculators, so I suggest checking it out. But to be honest, I actually thought that 11.05% sounded a little steep. So I scrolled down to the page to see, what they had said about what a good personal loan rate is. As you can see here, I'm not talking about charging 21, close to 22%. I'm not talking about 17.5% or even almost 14%. I'm going to assume in this case, that you have excellent credit. Maybe you do, maybe you don't, but I'm going to assume that you have excellent credit. So you'll be getting charged at 11.05%, which is even slightly better than excellent credit. Now, I put in the $20,000 here, the interest rate at 11.05%, the loan terms in 84 months, and it looks like you would be paying $342.97 a month. Now, over those 7 years, you're not only going to be paying that $20,000 back, but you'll also pay over $8,800 in interest on the loan, making your full loan payment back over $28,800. Wouldn't you rather be the financial entity earning some of that $8,800? If we look at that same $20,000, but loaning it from our infinite bank, here's how that would look. So first off, we're not going to be paying $342.97 because we're not paying 11.05% in interest. We're paying 5%. So we're only going to be paying $283 a month. So at the end of the 7 years, we're not paying over $8,800 in interest. We're only paying $3,745. Now remember, I said you can only borrow up to 90% of your total cash value in your policy. So if you're borrowing $20,000, that means that you have about $22,222 in your infinite bank. And that $20K that you've taken out, remember, that doesn't go anywhere when you use it. So over that 7-year period at not even 5.8% interest, just to be as reasonable as possible here, I'm going to lower it down to 4% interest. Now, remember, I told you earlier, this company hasn't paid out anything lower than 5.6% interest, but just to show you the power of this, I'm going to lower that down to 4%. And 4% compounding interest over 7 years on your full $22,000 is a little over $7,000 in interest earned. Now, if you take that $7,021 and you subtract your total interest paid, which was $3,745, that means you made a net profit of $3,276 by loaning yourself $20,000 over that 7-year period or that 84 months. You are a bank. You are earning the income of a banker, which is interest. When was the last time you were paid money after loaning yourself money? Now let's take this even a step further. Look at this $3,745. Where does that go? Well, what happens when you put more money into a life insurance policy? It raises the death benefit. And because the death benefit is attached to the cash value, it also raises the cash value. So you've got a win in the interest paid column. You've got a win in the net profit column because you actually have a net profit. I mean, you didn't have a net profit before. So I would consider that a win across the board. Now, let's look at another scenario here. What if you pay yourself back at the same rate as the traditional loan? Now, remember when I said that I first learned about having to pay myself 5% interest when loaning myself money? I didn't think it was a great idea, but as you can tell from the previous slides, that it definitely seems to be the better option. But what if we took it a step further and instead of paying ourselves 5% interest, we decided to pay ourselves back at the same rate that the lender is charging us? So for this example, we'll say that at 11.05%. What ends up happening then? What does that do? Well, first things first, it takes that 84-month loan down to 60 months. The next thing it does is it earns us more money in interest. And as we pay more money into the policy, the death benefit ends up increasing. Our cash value goes up and the money we're making goes up as well. Take a hypothetical situation that you didn't go with the infinite banking and you just went with the typical 20,000 loan. Great, you can definitely do that. But what if you lost your job and you needed 6 months to get back on your feet financially? Would a traditional bank give you a break on your loan payments. Let's say you fall on some kind of hardship. Maybe you got laid off. At some point, can you go back into Bank of America, back to that corner office, back to the loan officer who originally approved you for the loan? I'm sure they were super nice and, buddy buddy with you. Can you go back to that same guy at Bank of America and say, you know what, man? I just got laid off. I know I'm supposed to pay you guys $342.97 a month, but do you think I could lower that to say $50 a month for the foreseeable future? Do you think they are going to say yes? No. You know they're not going to say yes. They might give you a grace period if you're lucky, but they're still going to come back to the fact that you owe them $342.97 a month. But with this, you own the bank, you own the loan, and you have the power, the control, and the flexibility to do anything you want. So if things are tight and you need to cut back the payment to, $50 a month until you get back on your feet, start making full payments again. Luckily, I imagine and like you, so you're probably willing to give yourself that break. It's as simple as that. Now, does paying back a loan at $50 a month instead of $342.97 extend the duration of the loan? Of course it does. We're not talking about magic here. We're talking about math. But luckily, you don't have to worry about asking permission from anyone. This is your bank, this is your loan, and you do what you want with the money. That's the control that we're talking about. Here's another hypothetical. Let's say that you took that loan from Bank of America, that $20,000, and you're paying it and you're paying it, and you get it down to about 10K, and then boom, on the way home from work, you have the worst day of your life. Someone runs a red light, smashes into you, and you don't make it. Do you think Bank of America, in all of their generosity and, the great bank that they probably are, do you think they're going to go to your family and say, hey guys, listen, we understand that you just had the worst day of your life and you just lost the breadwinner. So let's just forget about the whole loan thing. We're just going to wipe that slate clean and forget about the 10K. Unfortunately, no, they won't. Whether it's coming from a spouse or an estate, ultimately, they're going to say, hey, you know that $342.97? Yeah, it's due on the 15th. But we're deeply sorry for your loss. But with an infinite bank, if you took that loan from your infinite bank, then your loan is attached to a death benefit. So that $10,000 that you had left to pay on the loan before you passed in the car accident, well, that $10,000 will be subtracted from, let's say, your $1 million death benefit, and the rest will be paid out to your family tax-free. I don't know about you guys, but I think that's a better deal. Here's one more scenario. Again, I really want to make sure that you guys understand how powerful this is. So what if you took my advice and you're filtering as much money through your infinite bank while keeping, again, a responsible amount in your checking account, but you reach the peak of your income earning potential and you're filtering a good portion of that through your infinite bank? You're maximizing your income and you're minimizing the ability for the bank to earn money off of you. But then you turn 65 or 67 and you want to retire. Can you change the amount of money you're filtering through your bank? Absolutely. And here's what that looks like. So first you can see the number one, premium payments are split into two pieces. The first going to paying the policy. It creates the structure of the infinite bank. It creates the floor, the ceilings, the walls, helps give us all these benefits that we've been talking about. Anything over and above the cost of insurance just flows into your cash account. And after the very first month of your payments, at any point in time, you can lower that down to that $50 a month. Now, on the other side, we already talked about that. That's your loan repayments. When you're paying back loans to yourself, no matter how big they are, you have the ability to lower those loans down to $50 a month Or, of course, you can increase them, but you have the control, you have the flexibility, and you have the liquidity to do whatever it is that you want to do. Section 7702 of the IRS tax code allows us to overfund a life insurance policy and pull out money tax free. So that's exactly what this infinite bank is utilizing. Now, loans in this country are not taxed. Death benefit of a life insurance policy is also not taxed. And in order to stay tax free, an infinite bank must be properly structured by a qualified and licensed professional so that the cash value of the program never exceeds the death benefit. Essentially, what they're talking about is if at any point in time in your policy you have more cash value than you have death benefit, then that's what we call a MEC. Your policy will hit a line called the modified endowment contract, and that will turn your policy into a taxable asset. Now, there's all sorts of precautions and measurements to make sure that that doesn't happen. A lot of communication between the agent and yourself, the company and yourself. So that's not something that you have to worry about. How about sheltering your assets? This is a huge benefit for a lot of people of having your money in an infinite bank. We like to say your infinite bank acts like a Swiss bank, but lives locally. Profits and gains within an infinite bank cannot be seen or be taxed by the IRS. That's huge. If you're ever sued, funds in an infinite bank are safeguarded and inaccessible to plaintiffs. Funds within an infinite bank are not counted against you for FAFSA, unlike they are in a 529 plan. So funds within a 529 plan are seen essentially as income. The more income you have, the less money your child may qualify for when it comes to FAFSA. So put that money into your infinite bank as your child grows up. When the time comes for your child to go to college, if they decide to go to college, get as much student aid as you can. And when the time comes to pay for the loans, take them right back out of your infinite bank and pay them. The really cool thing about this is if your child doesn't decide to go to college, well, no sweat off your back. But with a 529 plan, that money essentially is just going to have to sit there because it's very strict on what it can be used for. Now, that covers the fundamentals of infinite banking, but let's see how it really works in action. How to become the banker. First off, you've got your premium payment, which go into your participating whole life policy, aka your infinite bank. And once it's in there, it does two things. It gives you tax-free death benefit, and it gives you tax-free compounding interest. That's it. That's all it does. Now let's talk about how banks make money, because this is very important to understand because you are going to be playing banker. So I think we all pretty much know for every $1,000 you put into a savings account in a traditional bank, if they are providing you 1% simple interest, which I think we've already established is not the case for the majority of people. Remember, 0.42% is the average that was stated. But for this example, we'll go with that 1%. So for every $1,000 you put in, you earn $10 in interest on the year. Now, over the course of that year, the bank will lend out your money at least 7 times before you see that money again. They're lending it all over the place. So if we do some quick math, that's $705 they're earning for every $1,000 that we put in. But wait, they do pay us $10. So at the end of the day, they're making an easy $695 for every $1,000 that we have in our savings. That's not a bad business plan, if you ask me. Now, here's how insurance companies make their money. Our premiums go into the insurance carrier's general account to invest. And once that's in their general account, they invest in 2 specific places. Number 1, the retail side, where they loan out money to third-party lenders like credit card companies, banks, auto companies, mortgage companies, etc., who then mark it up and offer those loans to the public, you and me. Sounds familiar, right? Now, there are some of you that might have realized that you're already involved in infinite banking, and unfortunately, it's just being used against you. The second way is they have a wholesale side where participating contract and policy holders are given priority in line to come in here and get that money when you need access to it. Now, here's how you make money with infinite banking. Let's say you have $20,000 in your compounding interest account, and you want to take $6,000 out to go on a nice vacation with the family. So you take out that $6,000 and you decide that you're going to pay that back to yourself over a 2-year period. Now, over those 2 years, you're going to pay yourself $317.48 in interest fees. Not too bad for that $6,000 vacation. Now, let's just say for this example, your death benefit is $500,000, which is used essentially as your collateral. 90% of your cash value will always be your credit limit. Remember, this is not one of those situations where you have $10,000 in your infinite bank and you want to borrow $100,000. I want to be clear, it doesn't work like that. Repayment terms are entirely up to you, but for this example, let's say you decide to pay that $6,000 loan back over a 2-year period, like I mentioned. Now, I gave everyone the benefit of the doubt again, and instead of using the 5.8% interest that they have been issuing over the last 3 years, I took this down to 4% compounding interest that you're earning on the full $20,000 over that 2 years, just to really underplay again the power of your infinite bank. And in doing so, you would still be earning a minimum of $1,632, even though you have lent yourself $6,000. Now let's go ahead and take a look at how this breaks down. So your interest in income is $1,632. And your expenses for lending yourself that $6,000 is $317.48, which means that you made a net profit of $1,314.52 while lending yourself $6,000 to go on vacation. Again, you are officially a bank and you are earning the income of a banker, which is interest. So let's talk about a scenario that most people have dealt with at some point in their lives. And that scenario is buying a car. Now, I've looked online and found out that with all this inflation, the average price of a car these days is $48,000. So let's look at a few ways that you could potentially do this. So the first person buys a car with an auto loan. They go to the bank, they get the $48,000 loan, and over 5 years, that person on a $48,000 loan is going to pay over $6,500 in interest. So over those 5 years, that person now no longer has access to that $48,000. They're going to pay over $6,500 in interest, but they own the car when it comes to the end. Now, this doesn't take into consideration that the car starts depreciating the moment that you drive it off the lot, but that's a completely different issue. What we're looking at here is a lose, lose, win scenario. So let's take a look at the option B. So the next person says, forget paying that $6,500 in interest. I'll just pay cash. So they go to their bank and pull out $48,000 in a sack of money or a briefcase, whichever you prefer. And they walk it over to the dealership and they set that sack of money on the dealership's counter and give them their $48,000. Now, over the course of that transaction, they no longer have access to their $48,000. However, they paid zero in interest and they own the car. This is what we would consider a lose, break even, and win scenario. Now, the third person says, you know what? I've got 50,000 some odd dollars in my infinite bank. I'll just take $48,000 from there and purchase the car. Now, over those 5 years, they're going to pay a little over $6,300 in interest, but they're going to earn over $11,500 in compound interest. So when it comes down to the win-lose column, what does this one break down to? Over time, they still have access to their $48,000. So over that 5 years, that money never went anywhere. They also made a net profit of just over $5,200 in interest, and they own the car. We call that a win-win-win scenario. In fact, from a net equity standpoint, they've actually doubled their net equity and made $5,200 in the process. That's the power of infinite banking. Now, here's a scenario that a lot of my clients, as well as myself, use. They pay their monthly bills with a rewards credit card like Southwest Rewards or American Express Cashback. So what they do is they take a good portion of their income and they filter it into their infinite bank while still keeping that responsible amount in their checking account. Now, at the end of the month, instead of paying American Express $300 a month, they take a loan from their infinite bank and they pay off their American Express in full. So instead of taking that loan from American Express and paying back on a monthly basis, they take that loan from themselves and they pay back themselves that $300 a month. In which case they are earning interest on paying their monthly bills, while at the same time, they're double dipping in the form of either cash back or miles or whatever it is that you're earning on your card. It's their money, they're in control. That means their money is working for them. And just to run through some other quick ways myself and many of my other clients use our banking system. When it comes to taxes, some of my clients kind of have an idea of how much they're going to roughly pay to the IRS every year. So they take that amount, they split it up by 12 months, and they deposit that into their infinite bank throughout the year. When April comes around, they take that money and they give it to their best friends or the IRS, but the money still sits in their infinite bank, earning compounding interest, saving for their future. Then you've got scenarios like investment opportunities here. I have plenty of clients who are investors who originally came to me and said, Sean, I don't get out of bed for 5.8% interest. I say, great. I'm a firm believer in diversifying your portfolio. But at the end of the day, where do you bank? Because if your bank isn't providing you with non-direct loan recognition, if your bank isn't providing you with 5.8% uninterrupted compounding interest, if your bank isn't sheltering you from taxes, then you're missing out. Also, as an entrepreneur, you're going to have good months and you're going to have bad months. Would you rather hedge your bets knowing that even in your bad months, your bank, of all places, is still going to continue to earn you money? This isn't the end all be all. Infinite banking is where your money should live, while it's also outside of the policy, working to help you earn in other areas. It's your ultimate safety nest. How about this? Take a look at these lists of companies here. What do you think all of these companies have in common? They all use infinite banking to run their businesses. But here's where it started to hurt a little bit when I finally understood how this all worked. According to this report about bank-owned life insurance, or BOLI, that came out in March of 2024, Bank of America has over $24 billion, that's billion with a B, worth of infinite banking that they use. Wells Fargo has over $18 billion. Chase Bank has over $12 billion. PNC Bank has over $11 billion. Guys, this is just the top 25. It goes on and on. And the fact of the matter is that whether or not you realize it, you're already taking part in infinite banking. It's just been used against you this entire time. Now, you don't have to have debt to make infinite banking work for you. But if you do, we strongly believe that this is the absolute best tool out there to not only help you lay out a plan to eliminate that debt in a fraction of the time, but it also allows you to do that while building an asset that is going to become more and more efficient at making you money over time. Now, listen, we did not invent the debt snowball, nor did we invent the debt avalanche. They have been around for decades, and they are tried and true methods of debt elimination. What we do have is a proprietary piece of software that takes your numbers, your principal balances owed, your interest rates that are being charged, the minimum payment that you are required to make on a monthly basis, and what you're actually paying if you do happen to be paying overpayments. And it crunches those numbers and builds a report that tells you the fastest, most effective, most efficient way for you to A, get out of debt, and B, build wealth. So for those of you that don't understand the debt snowball, here it is. The idea is that you're paying off the smallest balances first and working your way to the largest. And with the debt avalanche, you're paying off the highest interest rate first and working your way down to the lowest interest rate. But just like everything else we do here, it's not a one-size-fits-all solution for everyone, and that's where our software comes into play. Our software will tell you the fastest, most efficient ways of getting out of debt, and then build you a report down to the day, the date, and the penny of when you're going to be completely out of debt and how much wealth you're going to build over 20, 30, and 40 years. This is an actual screenshot from one of our clients. Understand that this is stuff we see on a day-to-day basis, multiple times a day. We've got credit card debts, personal loans, timeshare, cars, vacation, the dreaded student loan. We've got interest rates, which actually don't seem to be that horrible on these, 18%, almost 14%, basically 10%. Monthly payments. This is what you're required to pay. This is the minimum. Then we've got actual payments. So on some of these portions, like the credit card, they want to knock these out faster, so they're making overpayments. Same thing here a little bit on the car. They want to wrap that up sooner rather than later. Now, what's not on this screen is their mortgage. That's on another page, but we do take that into consideration as well in this overall picture. But with these consumer debts, plus their mortgage, and especially that student loan, this family would be paying off these debts over the next 40 years. With their debt elimination program that we put together for them, they aren't going to be paying for the next 40 years. They're going to be completely out of debt in the next 8 years and 11 months. Now, you can see here that their payments prior to debt elimination plan was $2,127.93, and the new payoff plan is still $2,127.93, the exact same amount down to the penny. But it's not 40 years of payments, it's 8 years and 11 months. And by the way, on top of that, they're going to be saving nearly $110,000 in scheduled interest payments. It's money going back into their pockets. I can't begin to tell you just how emotional some clients get when you show them that there really is a better way out there to eliminate their debt, that there's a light at the end of the tunnel, and that light is not 20 years, 30 years, 40 years down the road. But this goes beyond just becoming debt-free. Now, this family was going to be paying for the next 40 years. And in 40 years, they would just be finishing up paying off their last loan payment. But in this scenario, in 40 years, they have over $1.9 million in assets. This is a phenomenal program. And I hope you can see why we're so passionate about teaching people about this. That's why I've stopped so many of my friends and family that I possibly can and urge them to sit down, take 45 minutes, take an hour, and really allow yourself to understand what this could do for you. Because who couldn't build a better life if they weren't worried about being buried under a pile of debt? Who couldn't build a better retirement? This is literally rewriting the financial futures for so many of my clients, and we know it can for you as well. So if you like what you've heard and you want to learn more to see how your numbers play into this system, then you may be asking yourself, all right, what are the next steps? What we want you to do is gather your most recent statements. This isn't a one-size-fits-all solution, so in order for us to customize a plan specifically to you, we'll need to understand your financials. Any existing assets like IRAs, 401ks, annuities, savings, anything like that. We'll also need your monthly expenses. When you're paying something that has an interest rate, please include the balance owed, the interest being charged, or future interest if deferred, the minimum payment required, your actual payment. For mortgage purposes, please only include monthly principal and interest, not escrow or taxes. If somebody sent you over this video, please get back with that person and they'll help you get scheduled. If you saw this on our website or if I personally sent this information over to you, please go ahead and head back over to the website, legacylifeandretirement.com, and make sure you book an appointment from there. We only do these meetings over Zoom so that you can see us and our screens in case, we need to share visuals to explain the concepts that we're discussing, but we also like to see you and we like you to see us. So please have your cameras on. Please be in a place with steady internet connection. Of course, that's always going to help. On the day of our meeting, please be on time and ready to go in a space with limited distractions. Unfortunately, these concepts don't translate well when you're trying to explain them to somebody who's driving home from work. And last but not least, if you feel the need to discuss this program with a spouse, a friend, or financial advisor, please just feel free to invite them to the meeting. We try to play as little telephone with this as possible because we know if we can get everybody involved who's making the decisions and they see it and hear it from us, they'll understand how powerful this is as well. With that being said, remember, this plan isn't going to make you rich overnight. But if you follow the process of banking and you start to capture some of, if not most of the interest that you've been missing out on your entire life, you have the ability to build something truly incredible here. I just want to say thank you for your time. We look forward to hearing from you, and we look forward to meeting you on our next Zoom appointment.